Stocks versus ETFs. What's the difference and which one's right for you? When you're just starting to invest, choosing between stocks and ETFs can feel confusing. But here's a simple way to look at it. Think of it like choosing between one flavor of sparkling water and a variety pack. Stocks are like picking just one flavor, like any single company. While ETFs are like grabbing a mix of flavors, like a bunch of companies in one investment. Both can be great tools for building your investment portfolio. Let's get into it. What are stocks? Stocks are shares of ownership in a single company, like Apple, Tesla, or Shopify. If the company grows and becomes more valuable, so does your stock. Stocks let you vote on some company decisions and sometimes pay dividends like cash payouts to shareholders. They can be very profitable, but also very risky. A single piece of bad news can hurt the stock price. You're in charge. That means researching companies, buying at the right time, and keeping up with market trends. What are ETFs? ETFs, also called exchange-traded funds, are investment bundles that hold lots of different assets, usually stocks, but sometimes bonds, real estate, or commodities like gold. Think of them as a pre-built investment portfolio you can buy with one click. Most ETFs follow a theme or strategy, for example, tracking the S&P 500, or focusing on clean energy companies. They're managed by professionals who rebalance the fund for you, so you don't need to do much. ETFs offer instant diversification. Spreading your money across many companies reduces your risk. Some ETFs also pay dividends, and they typically have low fees, especially index ETFs. Dividends are payments made by companies to their shareholders, based on the number of shares they own. How are they similar? Both are traded on stock exchanges, so you can buy and sell them during regular market hours. Both have ticker symbols, an abbreviation used to uniquely identify publicly traded shares of a particular stock or security on a particular stock exchange, like AAPL for Apple, or VOO for an ETF that tracks the S&P 500. Both are regulated, meaning they follow strict transparency rules, so you can see what you're investing in. Both allow you to build wealth over time, especially if you hold them long-term and reinvest your gains. When deciding between stocks and ETFs, several important factors come into play. Stocks are like picking your own team. You could win big, but it takes research and comes with more risk. ETFs are more like joining a ready-made team. Less risky, managed for you, and perfect if you're just starting out. Stocks need more effort and attention, but ETFs let you chill while your money works. You can start both with a small amount, even $20 to $50. And it all depends on your style. Active investor? Go for stocks. Beginner or busy? ETFs are your bestie. Can you invest in both? Yes, and many smart investors do. You might use ETFs as the foundation of your portfolio for long-term stability and growth, and then add in a few individual stocks for higher reward potential or companies you believe in. For example, use an ETF like VTI, Total US Market, or VEQT for Canadians to cover the market. Then buy shares of companies like Nvidia, Shopify, or Apple if you think they'll perform well over time. The bottom line, stocks are great if you want more control and are willing to do the homework. ETFs are a smart, low-stress way to grow your money without needing to be an expert. Using both gives you flexibility, balance, and the chance to grow wealth while managing risk. Whichever you choose, the key is to start investing early and stay consistent. Over time, your investments can grow significantly thanks to compound interest, even with small amounts.
Thanks for watching. Please like, share, and subscribe. See you in the next one.